After defining the direction of the current market trend and the balance of power between market participants, we can proceed to the rules of the trend reversal. Here is how a reversal of trend in terms of graphical analysis looks like. Suppose the market develops an uptrend, and we see that the price approaches an important resistance level. This level is indicated on the chart with the red horizontal line. Perhaps this resistance level has been formed on a daily, weekly, or even monthly chart. You can define such levels by yourself. They are clearly visible on larger time frames. When it comes to reversal on the top of the market, the following setup unfolds on the chart. The market price approaches the resistance level and forms the key high H1. Then, the market retraces down and forms the key low L1. As a rule, in the case of an uptrend reversal, the key high H2 is lower than the previous one. Once the price breaks through the local low L1, a chart pattern called failed upswing shows up on the chart. It is a formal signal of uptrend reversal. The reversal on the bottom of the market looks very similar. As you remember, moving averages quite well perform the role of support and resistance. This quality of indicator is widely used in the multi-timeframe trading strategy. Suppose the red line is a moving average with the parameter of 200 intervals, built on 4-hour chart. The slope of the red line indicates the direction of the long-term trend. The price approaches the moving average line from below and forms the key high H1. Then, the market retraces down and forms a key low L1. As a rule, in the case of the price reversal and completion of the upward correction, the key high H2 is below the previous one. Once the price breaks through the local low L1, a chart pattern called failed upswing shows up on the chart. It is a formal signal of completion of upward correction. The reversal on the bottom of the market looks very similar. So, from the point of view of graphical analysis, the probability of a price reversal, both in the case of trend and in the case of correction, increases under the following conditions. 1. The price approaches a level of support or resistance. 2. The failed downswing or the failed upswing pattern is formed near the level of support or resistance. Or 1. The price approaches a pair of moving averages with the parameter of 200 time intervals. 2. The failed downswing or the failed upswing pattern is formed near the pair of moving averages with the parameter of 200 time intervals. After the formation of the formal signal of price reversal described above, the trader should be ready to close a position which was opened in the direction of the trend earlier. Conversely, the trader should be ready to open a new position if the position which was opened in the direction of the trend earlier was closed after the beginning of the correction against the trend. The examples of formal signals of the completion of correction are shown in the slides below. On the first slide, you can see an example of a failed downswing and a formal signal of completion of downward correction. On the second slide, you can see an example of a failed upswing and a formal signal of completion of upward correction. So, let's move on to the next rule of the multi-time frame trading strategy. It's time to consider the rules for opening and closing positions. As I mentioned above, the price reversal is often accompanied by a chart pattern called failed swing, which, in fact, is a formal signal for opening a position. However, the market does not always offer such perfect conditions. There are multiple situations where no failed swing pattern is generated, so trader has to use a universal method described below. So, let's consider the initial conditions for a short trade. When the market develops a correction against a downtrend, the balance of power between market participants may be as follows: 0-1-2, 1-0-2, or 0-2-1. Only situations number 1 and number 2 are appropriate for opening a short position. The balance of power there looks like 0, 1, 2 and 1, 0, 2. That is, those are the situations in which bears have an advantage over other market participants. Formally, any two of the following three conditions must be met when you open a short position. 1. Three pairs of moving averages have formed a bearish perfect order configuration, or a pair of short-term moving averages is located in the space between a pair of long-term and a pair of medium-term moving averages. 2. The recent swing with the amplitude over 100% of ADV relative to the pair of the medium-term moving averages is pointing down. 3. The recent swing with the amplitude over 150% of ADV relative to the pair of the short-term moving averages is pointing down. Now, let's consider the initial conditions for a long trade. When the market develops a correction against an uptrend, the balance of power between the market participants may be as follows: 210, 201, or 120. Only the situations number 1 and number 2 are appropriate for opening a long position. The balance of power there looks like 210 and 201, that is, those are the situations in which bulls have an advantage over other market participants. Formally, any two of the following three conditions must be met when you open a long position. 1. Three pairs of moving averages have formed a bullish perfect order configuration, or a pair of short-term moving averages is located in the space between a pair of long-term and a pair of medium-term moving averages. 2. The recent swing with the amplitude over 100% of ADV relative to the pair of the medium-term moving averages is pointing up. 3. The recent swing with the amplitude over 150% of ADV relative to the pair of the short-term moving averages is pointing up. So, let's define the price levels where the trader should place the orders used for opening and closing positions in accordance with the rules of multi-time frame trading strategy. For this purpose, let's consider the most common scenario, that is, opening a position after beginning a short-term correction, which goes against a well-defined trend. On the next slide, you will see the layout of pending orders used for opening a long position. For the sake of simplicity, the price line is not shown in the diagram. As you can see on the chart, the lines of the three pairs of moving averages are arranged in a configuration called perfect bullish order. If the balance of power in the financial instrument looks like 210, then it is necessary, in accordance with the specified diagram, calculate the price levels of pending orders used for opening a position and limiting potential losses. Of course, in addition to this, trader should also calculate the volume of the transaction. So, the order for opening a long position will be set at a distance of 75% of ADV above the minimum values of the pair of short-term moving averages achieved since the beginning of the correction. The order for limiting the potential losses will be set at a distance of 50% of ADV below the minimum values of the pair of short-term moving averages achieved since the beginning of the correction. Trader should take into account the spread while placing all buy orders. On the next slide, you can see the arrangement of pending orders used for opening a short position. Here, everything is mirror opposite of the diagram discussed above. At the time when conditions for a trade are in place, the main task of a trader is timely and correctly place all orders required for opening and closing his position. In order to do this properly, trader is recommended to use a bundle of conditional orders, such as if-done orders. In order to ensure an accurate and fast calculation of all price levels needed for setting pending orders, trader can use a special table, an example of which is shown below. In this table, trader must specify the 4 technical parameters of the trade: the current price of the instrument, the current volatility of the instrument, the minimum and the maximum values of the pair of short-term moving averages achieved since the beginning of the correction. As a result, trader will get a new set of technical parameters of the trade. All price levels needed for setting pending orders, open, stop loss, as well as target number 1. In addition, this table can also be used for calculation of the lot size, potential profit and risk of the trade. Now, let's review the algorithm of traders' actions before and after opening a position. 1. The very first thing a trader has to do is to determine the parameter of volatility of the financial instrument, that is ADV. 2. The next step is to determine the level for opening a position, open. Step number 3 is to determine the level of stop loss, SL. 4. Before opening a position, it is also necessary to determine the levels of target number 1 and target number 2. Target number 1 for a long position will be located at a distance of 100% of ADV above the position entry level. Accordingly, target number 1 for a short position will be located at a distance of 100% of ADV below the position entry level. The strong level of support or resistance on a daily or weekly chart will serve as target number 2. 5. After determining the levels of price targets, trader should place all necessary orders. 6. After the price has reached the target number 1, it is necessary to transfer the stop loss order to break-even point. 7. As the price continues to move in a favorable direction, trader should use the trailing stop equal to 100% of ADV. After opening a position, the main task of the trader is to maintain it until the end of the trend and squeeze the maximum profit out of it. As I mentioned above, a trailing stop is used for this purpose. However, if the price has gone the distance equal to 200 to 300% of ADV and more from the entry point, and approached a strong level of support or resistance on a daily or weekly chart that you had identified as target number 2, then sometimes it is better to close the position at the current market price. This rule is especially important when a failed swing pattern is formed near the strong level of support or resistance. Now, let's get to the practical examples and see how the multi-timeframe strategy works in real time. Suppose a trader has opened a short position. The price went down, traveled a distance equal to 100% of ADV from the entry point, and reached the level of target number 1. Immediately after reaching the target number 1, the stop loss order should be moved to break-even point. If the price continues to move in the favorable direction, a fixed stop loss order must be changed into a trailing stop. Until the position is closed, the trailing stop attached to the position should be located at the price level, which is 100% of ADV away from the extreme point reached by the market. The next slide shows how the strategy works in the case of a buy signal.